Hi, I'm Steve Van Metre. Welcome to your Monday night update where we take 15 minutes and try to figure out what is going on in the economy and the markets. And so my question tonight is, did China just win the trade war? Because they're certainly celebrating like they are. I mean, their stock market was up last night. And of course, that was expected to filter across to the U.S. market, which, I think President Trump even kind of was insinuating that we should be at new all-time highs because we're closer to a deal and there's no information on what the deal is, but we're close. And it's kind of interesting of how this is kind of breaking down because it does appear that there is a deal and Wall Street is acting as if there is. And this is one of those cases of, do you buy the rumor, sell the news? No. This is where it comes down to the news. The markets make the news doesn't make the market. So the news outlets are going to look at the markets and go, well, Wall Street is cashing in on their profits from the market going up on the trade war. No. That is furthest from the truth. The fact of the matter is the only reason the market is up, as I covered on our Friday update, is corporate share buybacks are at nearly double their pace of last year. Now, granted, keep in mind, we're not double the amount of share buybacks projected this year. We're just running at double the pace because corporate executives are trying to cash out as quickly as possible, and they are cashing out fast. And then we had two different computerized models, the CTA quant models and the risk parity models, that are effectively just leapfrogging each other to buy stocks every day at a higher and higher price point. Between those three, you've got a market that's right back at 2,800. So how do we know that perhaps there is an actual deal that's been struck between the United States and China? Well, there's some circumstantial evidence. The big one is both economies are hurting. While in the United States, we're looking at the stock market as a proxy for the economy, which is not a good place to look. The underlying data isn't that great. And I want to show you some data that is that assuming the Trump administration knows this and they know this data is coming and it's not good. So they do need a win here. And China does too, because the tariffs are hurting them. Now, granted, they aren't paying the tariffs. We as American consumers, that's how tariff works. We pay tariffs. So it's really a tax on Americans. But there is a second thing that happened, is that there was no deal struck. There's no information that came out after the last 2 weeks, because we went to China and then we took the weekend off and then they came here and then we ran through the whole week plus the weekend, and now they're presumably headed home. And what did President Trump say? He said, well, I'm inviting President Xi to Mar-a-Lago to kind of, he insinuated to wrap this up. Now, why would that happen? And you have to really, think from a publicity standpoint. Well, who started the trade war? Well, we did. Who specifically? The Trump administration, right? I mean, look, I'm not saying good or bad. I'm just saying this is how it goes. So who needs the win? President Trump does. And who needs the win from the Chinese standpoint? Well, their president as well. I mean, so if the two heads of state meet and then they go back home and sit and what doesn't matter who says what, we beat them, they beat us, it doesn't matter. I mean, everybody's a winner. Looks good. And so that's why some people now in Wall Street are thinking, hey, there's a deal that's been made. Of course, what you expect is stocks to go to new all-time highs. And if we look at it, well, that didn't quite happen either. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell a security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steve Van Metre. Own personal capacity. Opinions expressed in the video that I do not reflect the view of Atlas Financial Advisors Inc. or Steve Van Metre Financial. Now, I want to show you in the data, if I can get it pulled up here correctly. And here we go. So this is from Twitter today. And one of the reasons I love Twitter, not because I post there, if you're wondering, but you see this was posted by Teddy Valley, and he's a macro trader, I think. But he posted the first data merchant services. You can't read the rest, but it says credit card. And here, look at this data. We can see that in January and February, the credit card data is showing that consumers aren't spending. And he comments, for everyone that thought the most recent retail sales data was a fluke, January and February credit card data still off a cliff. And so what is that telling us is coming is worse retail sales data And then today, there's some validation. We saw wholesale inventories went up and wholesale sales went down. And this has been going on now for the past couple months. So all of this is validating that the U.S. economy is slowing down. And as I said, when these tax cuts were passed back in 2017, the deficit finance tax cuts, they're like a sugar rush. They come in, they hit you real hard, you're like, woo! And then at some point later, it's like, the drag is there. And we know the drag is there because the government's running these massive deficits, but they're also having to borrow more money to pay for the tax cuts because the tax data from both the federal government and the states show the tax cut is not paying for itself. Now, I'm not knocking. I'm just saying this as a matter of fact is what is happening. So if state tax collections are running below average and federal tax collections are contracting, that means American consumers are forced to borrow and pay for all this money. And when we look at the weekly Treasury auctions and we see that foreign investors aren't gobbling up, lots of U.S. debt like they have in the past, well, that means American investors have to buy it, and that takes money away from risk assets. And that is not what stock investors want to see. So let's take a look at how the markets reacted to this today. And let me get some of this stuff cleared out of my way. There we go. All right, so let's start with the S&P 500. I want to zoom this back out a little bit. I found a nifty little tool in here. Because right now, this seems to be the idea is you buy whatever the dip is and you sell around 2,800. So here we are at between 2,820 and we'll say 2790. That's pretty close to where I want to be. And we're going to draw this little box in here. This is what the sell zone is. So you have in the past, going back to February 2018, when prices got back down here, sellers. When they got up here late February, sellers. When you got here in March, sellers. When you got here in June, sellers. When you got here in October of last year, sellers. Again in November, sellers. And then in late November, sellers. And what is coming here? You probably can guess it, more sellers. Now, the bulls need to drive this thing higher to reclaim their all-time highs. But right now, you've got 1, 2, 3, 4, 5, 6, 7. We're now at the 8th point. And normally from technical analysis, which looks at chart patterns and tries to discern market reaction, it's pretty unusual that you have 8 tops at the same spot. The fact it's not in the books. If you go read books on technical analysis, they're not going to say, when you find the 8th top, you're pretty convinced that that's where it is. Usually it's 2, maybe 3, but 2, most common. And we're at 8. So it's getting very, very clear the market is selling at 2,800 to 2,820, which suggests at the moment prices are about to head back down. Now, the question will be, do those prices hold their December lows? It's very normal. You can see here, came down, bounced up, eventually came down and retested the February lows. Again, retested again. Came down here, retested again. Tried to retest it and failed. So you see the markets are constantly retesting prior points to see where buyers and sellers at. Right now we know this is where the sellers are at and the buyers have been here, but due to this last breakdown, we now know the buyers are down here. Are they tapped out? Well, we'll find out soon enough. So let's take a look at 10-year Treasury yields, and we'll just leave it zoomed out. Again, big, beautiful, broad topping pattern. We kind of looked at that on Friday as well. Here we see the 50-day moving average. No touch in sight here. So again, here's the big support level on 10-year Treasury yields sitting at 2.62-ish right in there. If this breaks down, you're going to start getting that big short squeeze I've written about for a while. Let's look at the 30-year yields. This is where the interesting action is coming. On Thursday, they closed over their 50-day moving average. On Friday, they closed below. And then on today, they started the day higher and closed below again. And this is where it comes back to rallies begin with a cross of the 50-day and are confirmed with a 50-day. Now, This we have to turn upside down because we're talking about yield. So let's take a look. When we look at here, we see a cross of the 50-day, and now we're seeing it trying to reconfirm. And if yields stay below the 50-day, this is from a technical perspective saying that yields are not going higher, they're going lower. And so that means people are going to come in and buy bonds or exit their short positions, and that should take yields down. Now, it also helps that today we had two auctions, a 2-year Treasury and a 5-year Treasury auction, and the 5-year yields were lower than 2 years. That is a major, major red flag. When yields curves start to invert, it's dangerous because banks, again, lend at the long-term rates and borrow at short-term rates. So when short-term rates are higher than long-term rates, guess who doesn't lend? You got it, the banks. All right, let's kind of explore what's going on with the rest of the charts. Looking at volume today, again, you don't see any strong volume over any of this rally. It's pretty lackluster. And anytime you get a rally on declining volume, you get selling. So we should expect this to eventually come back down. And that, I suspect, will start happening here this week. And let's take a look at oil and gas producers. President Trump, came out tweeting saying that we need lower oil prices, and oil and gas producers are rolling over. So here, let's follow this 50-day test. They crossed over and fell, crossed over and fell, crossed over, and so they would need to find support right in this support band, right where the 50-day is. If not, you're looking at least at a test of this bottom back in December, if not something lower. So we know that's coming. Let's take a look at the Goldmine Stocks. Those of you that are regular viewers know that I'm very interested in this for lots of reasons, but we've got major moving averages sitting under here on the daily. If we looked at the weekly and monthly, we'd see them there too. I had a hunch this was going to get rejected here. Right now, gold miners are tracking the market, which is not usually what you want, but if that's gives us a big sell-off in the market, that could give us a big drop here. Nevertheless, there is lots of support with these moving averages. We're looking for price to come down into here somewhere, maybe even as low as here. We'll just see what the market gives us, but the trend right now is pretty bullish for gold miners, especially when you start to realize central banks are talking about something called modern monetary theory, and that should scare you. And one of these days I'll write more. I'll write about it, but it's frightening. All right, so we got 3 minutes left. Let's move on and just confirm what we saw on the Treasury bonds. We've seen the 10-year, 7 to 10-year Treasury bond ETF just going flat. Here's the 50-day rising. That's good. Here's the 20-plus year Treasury bonds, and here we see the opposite of the yields. We see it held the 50-day on Thursday, failed to break out of into this resistance level here, came down, retested successfully the 50-day moving average. Again, this is a bullish sign for Treasury bonds. Absolutely a bullish signal here. And let's take a look at the surprise. Surprise of the day is if we are indeed, or if there's knowledge that there is a trade come and into the trade war coming, you'd think it would be bullish for agricultural commodities, and it is. But if you look at this chart pattern, you see the American investors came in and sold really strong today, which is odd because Asian investors were buying. And so this is really kind of interesting to me. And we have the growing season coming up. So in April and May, farmers that are growing soybeans have to decide if they're growing soybeans. And one of the interesting things about commodities, first of all, they never go to zero. So if you own them, you don't have to worry about it. As long as you buy them low, even if you don't buy them at the bottom, you're A-okay because they will rebound. But can you imagine a situation where the farmers aren't growing as many soybeans? There's massive crop damage due and lower yields due to this far, far colder weather. I mean, crops, you understand, our hybrid crops were designed to grow in warmer weather. They're not designed to produce as well in colder weather. So you've got potential for crop damage coming, lower yields, and then who knows what happens with trade war. My prediction, and just the whole off-the-wall prediction, is somewhere in this deal, Trump has negotiated a multi-year purchase with China to buy our commodities. That's what I'm guessing is in there. And it makes perfect sense. I mean, that's where a lot of his voters are, those farmers. I mean, they did support him, and, he's got to help them out. I mean, that's what he said he was going to do. So it'll be interesting to see. But again, I just remain very surprised to see that U.S. investors are really selling this down because at some point, we get this 11-year cycle start to kick in, and all these short sellers get kicked out, and you start seeing prices just go higher and higher. So it'll be interesting to see how that plays out, just from the dynamics of not only the solar minimum, the trade war, but you have the variable, the farmers. What are they? If they don't plant soybeans, what do they plant? What are they going to do? Well, the next couple of months we'll find out. But we're still in a blackout zone from the Department of Agriculture, who is not actually providing any crop progress report. So pretty much right now, everyone's just flying by the seat of their pants based on whatever knowledge they own or they know. But from what I'm hearing from traders is the sector is dirt cheap, and they're starting to bottom fish. And if they can get this thing reversed and start getting some short sellers to get squeezed out, there's a ton of upside. Again, back in 2008 to 9 or 2007 to 8, somewhere right in there, this thing doubled in almost 12-month period. So it's a lot of upside potential here when this thing goes. All right, so that's our update, and we'll be back probably Wednesday night. If you have any questions, I'm Steve Van Metre. Give me a call. Send me an email. I'm here for you. Bye now.